Good morning. I'm Fred Ruffy from the floor of the CME Group for Traders Exclusive. It's Thursday, February 14th, Valentine's Day, and the Thursday before the February options expiration. Yesterday was the expiration for options on the CBOE Volatility Index, or VIX, and we saw a big trade in the index that I'm going to talk about today. The index is, of course, a barometer of market volatility, and it's based off the implied volatility of S&P 500 SPX options. VIX is now tradable through futures and options. It's widely discussed in the financial press. And what we saw yesterday was a very large call spread in the May 18 and 25s. In this trade, an investor paid $1.03 for the spread, buying the May 18s and selling the May 25s. So what they're doing is they're taking a position on the view the volatility index is going to move higher, and the trade was impressive because it involved 113,000 contracts in each leg, or 226,000 contracts total. And if you buy a call spread, any call spread on an underlying, your break even at expiration is going to be equal to the debit that you pay plus the lower strike price. So in this case, 18 plus 103 equals 1903. And so for this trade to make money, if it's left open through the expiration, the VIX would need to settle at 1903, well, above 1903. Yesterday was the VIX options expiration for February, and the index settled at 13.07, which I believe is the lowest settlement print for VIX since June 2007. It compares to 13.69 in January and 20.44 a year ago. And at that level, we estimated that maybe 98% of the open interest in the calls on VIX expired worthless because it was at such a low level, and the strikes ranged from 9 all the way up to 80. And so what this position that was open yesterday was probably replacing a February position. So it's the February came off the board, and now someone opened a new big position in May. Now keep in mind, the VIX has been trading lower, so there's a lot of options expiring worthless, and so this trade is not necessarily a smart money trade you want to follow because of the fact that it's probably to hedge a portfolio. And I talked to the head market maker in the VIX from the VIX options pit a week ago, and I mentioned to them, how such a large number, 2.4 million calls on VIX have been expired, will expire worthless. And he mentioned, people that are initiating these huge spreads, they probably want those to expire worthless because really it's a hedge against something else. So when we see large block trades in the options market, it's interesting, and sometimes we want to maybe look at, analyze that same position, and if it makes sense for us, then we would mimic it. In the case of this VIX, huge VIX call spread though, that's not necessarily the case. So we want to keep that in mind, but nevertheless, it's an interesting trade, and we'll keep an eye on VIX and see what happens in the months ahead. I'm Fred Ruffy for Traders Exclusive from the floor of the CME Group. I'll see you next time.